Okay, so hello everyone. Welcome to this sort of macro preview, the macro overview for the upcoming week. I'm recording this on Sunday, June the 9th, about 6 p.m. So the futures markets are just opening. Let's have a look and see what's going on, guys. Basically, we just got the news kind of coming out of Europe that the elections for the European Parliament have come through. And it's no huge surprise, but basically it seems that a lot of the nationalist parties, especially on the right wing, have made significant gains, especially in France. Italy have done pretty well. We saw that they've done well in Holland, also in Germany. I mean, still the sort of the centrist parties, center right and center left, have the majority, but still pretty big gains, especially in France, for the Marine Le Pen's sort of a national front, so to speak, which they've renamed a bit. You can see here some of the headlines here. Meloni in Italy wins vote in Italy as far-right parties gain across the EU. But what's the big news is that Macron, the president of France, of course, has just called a snap election for the legislative elections, basically at the end of this month, on June the 13th and July the 12th, I think is the second runoff. So just before the Summer Olympics, which of course are going to be hosted in France. This is a bit of a shock decision. Keep in mind, this is not for the presidency. This is for the parliament. But nonetheless, it's just interesting to have a look. And we'll have to look when the European bonds open a little bit later. But let's just have a look here. I've been looking at Euro Swiss franc, which of course the cash market opens at 5 p.m. Eastern, and you can see here that Euro Swiss franc taking down about 20 basis points or so, been stabilizing, but at 5 p.m. that opened sort of went down a little bit lower, a little bit of a risk off here. This sort of sense that maybe Europe is drifting a little bit towards the right, a little bit authoritarian. I mean, we'll have a look tomorrow morning, but it's going to be pretty interesting to see how the European bonds react to that, whether there's a little bit of a hit to the French OATs, the bunds as well, and also the BTPs in Europe. So going to be kind of interesting there to see if that's considered a positive for Europe or a little bit of a negative. And keep in mind that if we go back, of the last 3, 5, 10 years, generally this idea is that some of these sort of more nationalist right-wing parties are a little bit, they're more in favor of asserting national sovereignty. So that's a little bit of a challenge towards the central authority of Brussels, and that seemed to be sort of anti-Euro, sort of anti-Brussels, and that historically has widened the spreads a little bit and put a bit of downward pressure on the euro, especially against something like the safer haven cousin in Europe, which is the Swiss franc or something. So kind of interesting there as well. Let's have a look at that. Apart from that, if we look in, let's just go back to sort of some daily charts here. So obviously what happened last week, especially on the Friday, we had non-farm payrolls. Now, a lot of people over the weekend, all of the Twitterati, everyone on Twitter is talking about the fact that the household survey was actually a little bit weak, but the headline number, the payrolls number, was strong. Of course, we can go into a lot of details, but I think whichever way you cut the cookie, the number was probably on the strong side, on the hottish side. Average hourly earnings were at 0.4%. So the point is that there's no way really that the Fed can, the market can try and say that the US economy is super weak. There had been some talk that, that growth had been sort of slowing down and stuff. But the reality is that the US labor market is strong, maybe weakening a tiny bit, but certainly, if we have a headline number of 275,000, yes, we can slice and dice all the data, the seasonal adjustments, the birth death rate. There's all kinds of stuff been reading over the weekend. But the point is that it wasn't a weak number, and that the Fed, it doesn't really give the Fed cover to be extremely sort of dovish. Let's keep it as simple as that. So we do have some data this week. Of course, we have a super important number on Wednesday, of course, which is the CPI. I'm going to talk about that a little bit probably tomorrow and Tuesday, but we've got the on Wednesday we have the CPI. Now, what's pretty crazy is that that's at 8:30, and then of course we have a very important Fed meeting coming out at 2 p.m. So we have to assume that a lot of what the Fed will sort of communicate with the dot plot and the summary of economic projections, some of that will be, of course, filtered through the eyes of the CPI numbers. So before this, so I think, on Monday and Tuesday, so tomorrow and Tuesday, there'll probably be sort of range trading. I can't imagine that any of the very big players will be doing substantial changes to their position, except maybe over in Europe a little bit. But what we do have is the 1-year inflation expectations coming out tomorrow at 11 p.m. That's kind of interesting. Just talking about inflation, I just brought up, I was just curious, I was looking at sort of some numbers here. And if we actually look, it's kind of interesting just to see, where the inflation swaps are. So what I've got here is, this is kind of a fun chart here, which basically if you look at the inflation swaps, so this is what the market, like traders who are trading inflation swaps, so where they think the price of inflation will be from a market perspective. And you've got here everything from the 1 year in the white, going all the way out the curve to the 30-year. And you can see they generally follow each other. But what we can see is that, we kind of know this, but it's nice to see this in graphic form. If we go all the way back to the height of the inflation kind of problems in, September 2022, you can see that was the inflation swaps up there. And generally, they have come down. There's been a couple of spikes, but generally they were trending down nicely towards the end of 2023. And we can see that at the beginning of this year, in January, the low, at least for the 1-year forward swap, was just under 2%, so 1.91. The Fed would have liked that. Again, for the other tenors, the other durations, a little bit higher. But essentially, that was sort of the best news we had. Ever since then, everything's been sort of moving upwards a little bit. Now, the question is, if we zoom in here, we could say, well, okay, what's been going on in the last month or two? What does the Fed think about that? If we look at, let's say, the 1 year here, it is sort of coming down a little bit. Now, it's not nearly a target. It's not at 2%. Now, again, this is not the CPI or the core PCE. This is inflation swaps. But I think this is actually an interesting way of looking at that. And we can see that, if you go a little bit further out, the 3, 4, 5 year, whatever, it's been ticking up just a tiny bit. But in general, you can say that, over the last 4, 5, 6 weeks, inflation swaps have started to drift downwards a little bit. So it's not all bad news. And it's just interesting to keep, these numbers in mind as we start to think about the Fed. Of course, we're going to get an update from that in this market. Obviously, it's going to update on Wednesday when we get the CPI. And we'll talk about that. But the thing is, I think the Fed will have to be a little bit sort of hawkish. So let's just have a look and see what's been going on. Just to, I'll talk about this a little bit more later on, probably Tuesday. I'll do some kind of video or so. But if we actually just remind ourselves and see what's been going on here. So if we look at we're going to get an update of the summary of economic projections, but just keep in mind that what they said for 2024 back 2 months ago was expecting 4.6. Now, remember, these are rounded numbers. So essentially what that's saying is that the Fed funds rate at the moment, is about 5.33. So we call it about 5.4, sort of rounded up. So basically, what they were saying is that they were expecting 3 cuts. So if we assume that the rounded number is about 5.4, what this 4.6 number they were projecting out at their last SEP from 2 meetings ago was 3 cuts. So really the question is, are we going to get 3 cuts? Are they still going to say that? And I think, to be honest, this number, it would be very, very doubtful this number stays at 4.6. I mean, surely that has to be revised upwards, maybe to 4.9 or even 5.1. So 4.9 would be just 2 cuts. And then something a bit more hawkish would be 5.1. So it's going to be absolutely essential to be looking at this number. And again, of course, between 4.6 and 3.9, that's another 3 cuts. So just keep in mind that what the Fed was telling us, essentially, what's that, two months ago, was they were expecting over the course of 24 and 2025, they're expecting 150 basis points or 6 cuts. And I think the market's going to react to that pretty much big time on Wednesday, but we'll talk about it a bit more. But I think we have to assume that this 4.6 number will be revised upwards hawkishly. Probably the 2025 as well will be revised upwards a bit. And then what's going to be pretty interesting as well is really, what do they say in, for 2026, but also the longer run or the R-star. As we all know, a lot of people have been sort of chatting, saying that the neutral rate, which is this sort of number here, this sort of longer run, that should be revised upwards because we are no longer in the same economy as pre-COVID or post-Great Financial Crisis. So I think it'd be normal for the Fed to at least kind of recognize that we're in a slightly different economic regime, to at least recognize the fact that the economy is not collapsing, that real economic data is still pretty strong. Of course, there's always going to be fluctuations here and there. So I think there should be quite a lot of focus also on the 2026 numbers and the longer range number. And I think if these numbers for 2026 and the longer run are revised upwards, I think we have to sort of say that maybe the Fed, the cutting cycle is going to be less than historically it's been the case. Historically, some of these cutting cycles have been, more 200, 250, 300 basis points. Maybe this time round, we're only going to get, maybe 5 or 6 cuts to be priced in between 24 and 25. And that would say that maybe, the Fed funds rate will only go down to maybe 4%, I don't know, 4.25% or something like that. Certainly a much more shallow cutting cycle. And that would seem to say to me that the curve should steepen. What we might see is a dynamic where the front end of the curve, the yields go down as the Fed cuts. But because the economy is seen to be sort of structurally, relatively strong, and more important, the neutral rate is seen to be, a little higher than it has been, let's say, for the last decade. Maybe what we see is a situation where the front end of the curve comes down in terms of the yields, but the back end of the curve, let's say like from the 10 and the 20 and the 30, they don't come down that much. They say, well, okay, maybe they'll come down 10 or 20 basis points, but they're essentially going to be stuck, somewhere around the 4.25 kind of mark, which would imply a steepening of the curve, a bull steepening. We're not there yet. Obviously, we have to get to the CPI. It's going to be very interesting to see how Powell spins that. And as I say, we'll get the first information on Wednesday with the summary of economic projections. We'll see what they're saying about the unemployment rate, but more to the point, the core PCE inflation and all that kind of stuff. But as I say, we'll talk a bit more down there. So if that's going to be the case, I think what we could do is to maybe look at a couple of charts here. I think we've got this one here. So let's look at the, just by the way, the Euro Swiss franc. Let's put on the daily here. Be interesting. That's already come off quite a lot. So I wonder if there's more downside, maybe a huge, maybe not too much more. But just if we assume that the Fed, again, let's start with the bonds here. What we saw, of course, is that I've been saying that they're going to go in this sort of range here between about 5% down to about 4.75, and that seems to be the case, because the point is that if the Fed funds rate is at 5.33, we have to assume on the 2-year yield that sometime over the next 2 years the Fed will be cutting at least I don't know, once at least. Surely, even up to sort of 5 or 6 times. So it seems to me very unlikely that, I've had this level up for a long time, that the 2-year yield is going to go any higher than, let's say, about, 505 basis points, 508, 510, something like that. And I have to say that if it gets up here, that would be a pretty good risk reward, around about that 5.05, 5.08, 5.1. Just to basically go along the 2-year, or maybe the TUA on that ETF there, or maybe something like the SOFR, the Z5, like the December 2025. Now, what we had is that there was a little bit of mixed data at the beginning of last week, with ISM services, ISM manufacturing, et cetera, et cetera. ADP was a bit lower than expected, the JOLTS number, et cetera, et cetera. And the market was very quick to extrapolate from that the real economy is slowing down, that the labor market was softening. Maybe. Personally, I think there are signs that, the real economy is softening slowly, slightly, okay, but still not anything like a weakening economy, and certainly very far from a recession. And as you can see, the market here is reacting. We had a beautiful bounce just off this sort of key level here, about 4.71 percent on the 2-year yield. And basically, the market was very happy in a jiffy, in literally sort of half an hour, to price in another 16 basis points more of less cuts. So we can see that if we look at something like just the price action here on, let's say, the SOFR contracts for December 2025, you can see that went down. Like, that's very accurate here. We'll see that went down about 19 basis points. So that's 19 basis points of more hawkishness, basically. Okay, so what the market is sort of saying is that, yep, we think the Fed will cut at some point. At the moment, it's priced in. If we look, let's see what's priced in for the end of the year for December. Where are we? We'll go here. I believe that is. Yeah, so we can see that. Sorry, guys, there's a lot of stuff on my screens here. I have to constantly be jiggling things around. But we can see what's priced in now is only 36 basis points of cuts by the end of this year. As recently as, I think like a week ago, that number was 50 basis points. So at this point, we are very much data dependent. That's what the Fed keeps on telling us. Okay, so we see the data on Wednesday with the CPI, and then, from that, the Fed will extrapolate. But certainly, the 2-year anywhere at about, 505 or 508, 510, I think would be pretty good. So what about the rest of the curve? I think you've got to say that, if we assume that the neutral rate or R star is going to be, a little bit more elevated, as I said, than the last sort of 10 years. If we assume that the economy, the global economy is structurally a little bit more inflationary than we've seen from the decade post-financial crisis, maybe this cutting cycle will not be as deep as we've seen in the past, unless we get a major surprise, a massive geopolitical event, we get some kind of massive deflationary sort of force or recessionary force. But maybe really what we're looking at, as I say, is maybe 150, 175, 200 basis points of cuts, which means that the long end of the curve, maybe is not going to come back down that much in terms of the yield. So maybe anything from like the 5s, the 10s, and the 30s will not come down that much, and that assumes that there should be, those yields should stay relatively elevated, and of course we have a huge amount of supply, and don't forget that this week as well we have 3s, we have 10s and 30s auctions, huge amount of issuance happening this week. We actually have the 30s on Thursday at 1 p.m., the day after the CPI and the Fed. So it's going to be the first test just to see whether the bond market is happy to keep on absorbing at current rates, at current yields on offer, all of this issuance, and maybe not. So there's going to be some tests for the bond market. So all that to say, I think we can continue to see some steepening at some point. And if we actually just look at some of those basic charts, let's look at, let's say, the 10s to 2s, or the 2s 10s, which is the classic one in the US. Where are we here? US, maybe that's the 5. Yeah. So if we look at the 2s to 10s, we can see actually it's been flattening, but I've got to say that, assuming the Fed is, we'll see what the Fed has to say. And again, I will talk about that later, at the beginning of the week sometime. But I think anywhere which gets down towards this minus 53 basis points, minus 50, anywhere in this kind of zone here, I've put this sort of, blue buy kind of thing here, anywhere around here, let's say 50 basis points or more negative, I think would be a very attractive risk reward for a steepener play. Again, based on the idea that, either the curve, when and if the Fed starts to cut, will be a bull steepener. If not, we have to assume that, that the bias is for the front end to be relatively anchored once it hits that sort of, 505 point on the 2-year, and any sort of pain to be felt at the longer end of the curve. I think that's the way to be looking at things. The same thing if we look at, let's say, something like 5s, 30s. Again, I think an attractive risk reward, maybe not here, but would be down here somewhere, let's say around towards the 0 to 5 plus 5 basis points. So anywhere in this zone here between 0 and 5 basis points, I think would be pretty attractive. Okay, so what about Europe? Obviously, we had the ECB with a pretty hawkish cut last week, but the point is they have started to cut. And but what's interesting, if we look at, let's say, the German yields, we can see here, let's say on the German 2-year, what was interesting is that, of course, in sympathy for the US on Friday after non-farm payrolls, it went up. But basically, we're not really seeing the yields go down that much at the front end of the curve. This is the 2-year. But again, I'd have to say that, anything above this sort of level up here, let's say 317, let's see, I don't know, let's say 315, 317 up here, this sort of level here, anything in this sort of red box, even maybe a little bit higher, I think starts to become an attractive risk reward, because the reality is that the ECB has started cutting. Now, of course, they've told us that they're data dependent and it's not going to be every meeting, and it might just be every second meeting or every third meeting, et cetera, et cetera, et cetera. But the reality is the ECB has actually cut. They are starting some sort of cutting cycle. Yes, there will probably be more shallow than historically. But the point is that it's hard again to see the yields just mathematically going to much higher than, about the 3.17, 3.20%. So that's something I'll be looking at, anywhere around, 3.17 up to 3.20, I think would be pretty attractive to buy the Schatz. Now, would you buy the belly of the curve, the long end of the curve? Not really, because I think there's the same kind of logic in terms of the curve there, that I do believe the bias is for that curve to steepen as well, because at the end of the day, supply chain pressures, structural forces in the world, I think, it's for a steepener, similar kind of logic as in the US. So again, I think if it gets too much lower, down to about minus 50 basis points here in the German curve, you've got to say that could be pretty attractive to start making its way back up as well. So I think that'd be something I'm going to be looking at as well. Another one which is sort of interesting, just to keep in mind, and again, now that we've had this news that France is going to do a snap election, is again, we'll have to see how the price action happens overnight. If the market takes that as a sort of flocking towards the French bonds as a sort of, park your money in something safer. But I do believe that in France, a bit of a key level, I think I spoke about this last week, the 3.25-ish level. Here you see a bit of resistance here. If those yields do push up towards the 3.25, I think in France for the OATs, the French bonds, that would be a pretty attractive risk reward again to be buying that. Something around 3.24, 3.25, 3.26. Now, it's difficult with the options. The option chain is not particularly liquid on the OAT. So, as a proxy, maybe at that level, maybe something like buying the Bunds, sort of a call spread on the Bunds would be kind of interesting, or just an outright there. But that would be a pretty attractive entry level there to see what's going on there. Now, in terms of the differentials, something which is interesting is to look at the differentials between the US 10-year. So this is the US 10-year, subtract the German 10-year here. I was thinking about doing this trade on Friday, but it moved pretty fast. But what I would say is that if we can get back down a little bit here, I think there's a pretty attractive risk reward here. At the moment, we're trading at about 1.80, 1.81. I think if that could come down just we have a bit of a green candle here, obviously on the back of the non-farm payrolls. But I think, as I say, if that pulls back a little bit, that could be an attractive risk reward here to be selling the US 10-year versus buying the German 10-year, basically based on this idea that, the Fed, the Europeans may be cutting a little bit more than the Fed, and also really like this whole idea that the issuance is going to be much, much less from a structural point of view over in Europe than the US. At the end of the day, neither Biden nor Trump, whoever wins in November, has said anything about fiscal discipline. The US deficits are massive. They will continue to be massive. The reality is that inflation seems to be a little bit sticky in the US. The government, whichever party gets in November, will continue to run very high deficits and will not cut. Trump has talked about cutting taxes, and Biden will probably not increase taxes. So the point there is that the tax base will not increase. And the deficit spending will continue. So whichever way you cut the cookie, my thinking is that sort of medium term structurally, the issuance issue should favor the German bonds rather than the US bonds. So if we can just get that to pull back a little bit more, I think there's an attractive risk reward over there. In that spread there between the selling the US and buying the German ones, okay? And you're looking for maybe like a 10, 15 basis point profit. That's what we'd be looking for here. But as I say, that moved a little bit here. It's interesting because if we get a very hot CPI and we get a super hawkish Fed, I mean, to be honest, that could push up and maybe that trade will miss it. But if let's say we get a slightly cool number on the CPI and sort of a neutral Jerome Powell, if that pulls back 5 or 6 basis points, again, that would be an attractive entry level there. So based on that, we can let's just have a look at some of the currencies. Again, I don't think it's going to be a huge amount of movement before we get the CPI and the Fed. But what we are seeing, oh no, why is it Tuesday the 11th? That's a bit weird. Oh no, they're just saying on the Monday here. So what we are seeing here is that obviously the dollar index had been range trading, but on the back of the higher than expected non-farm payrolls that broke out, Now, again, if we do get a bit of a safe haven sort of risk on kind of bid overnight here with this news about the advance of the sort of the nationalist, slightly more right-wing parties, and a bit of nerves about the fact that Macron has felt obliged to call election in France, we could see the US dollar index here, which is, 58%, 58% sort of euro sort of breaking out. So we'll see if that keeps on pushing up. And again, on the euro here, we see that, it's gap down, as we see here, it's gap down on the open a little bit. Let's just see if it comes back a little bit. But as I say, the differentials, it's going to depend on those differentials we just looked at here. So let's see how it goes. On the euro, 107, down here, we'll see if it goes down a little bit more. Again, I have not too much to say. I think this will probably range trade, maybe down the lowish areas here, just waiting on the CPI. Not a lot to say there. Okay, in terms of commodities, well, what's pretty interesting here is gold. We saw gold. Let's look at gold here for a second, guys. So you see gold, this is just on the futures here. Gold had a very, very large sell-off. Now, that kind of came in two parts. If you look at what I'm going to do, I'll throw this back to, I don't know, what should we do? Let's say a 15-minute chart, just going back to Friday here. And what you can see is that it started selling off very, very hard at about 4 o'clock in the morning. A lot. And then as we got the non-farm payroll numbers on at 8:30, so 4.5 hours later, so we had a second leg down. Very, very big push downwards. A similar kind of thing in silver and also in copper in the other metal space. And you sort of say, well, why was that? And that was just on news that the data had just come out from the People's Bank of China. So I just want to look at, just spend a little bit of time here and look at a couple of things here. So if we actually look here, what I've got here is a chart of the holdings of the PBOC. This is what they announced publicly. And of course, what's really going on behind the scenes, how transparent are they? But the reality is that since the latter part of 2022, when the Americans started freezing the assets of the Russians after the invasion of Ukraine, a lot of people saying that the Chinese and other sort of let's say, Western banks, central banks, would try and, move away from, complete dependence on having the dollar as the reserve currency and buying a bit more gold. And that seems to have been the case. And what we have here is the China monthly gold reserves. And you can see that, the Chinese, the People's Bank of China, have been buying a huge amount of gold. And you can see that it started to like it really has ramped up over the last, what's that, sort of 18 months or so. But we did see a bit of a plateau. And if we actually just look at that, just in terms of the numbers, we saw these green numbers here. This is all the monthly price change, okay? So you can see here, like how much has been buying, and you go back all the way to 2022, and suddenly you see a lot of the net change. This is in I think this is in millions of ounces. So you see at the moment it's in millions of ounces, 72 million ounces, and you can see here that basically it's been green every single month. I mean, it's pretty impressive. You see the Chinese central bank, like plus 1%, in general over 1%. But what you can suddenly see for the first time, zero. So, and this is the number which kind of freaked out the market last Friday morning, that it was announced publicly. Now, of course, they might still be buying through proxy agents and all kinds of stuff. But the reality is that the People's Bank of China did not advertise buying any extra gold, as gold, was reaching sort of, all-time highs priced in US dollars at least. And that kind of freaked out the market. Now, the other thing, and I think until and unless we see more evidence that the central banks, the People's Bank of China, is starting to get back in the market, maybe gold's got to be under a pressure. And the reason for that as well is that if we look here, the real yield, and this is very interesting because historically, what do we have here? So we have here on the blue line, this is the price of gold priced in US dollars. And we can see this on the left-hand column here. So we can see, doing its thing. Then we started to see a big breakout in the price again, at the end of 2022, which corresponds to when the People's Bank of China started to buy. No problems there. And that's gone up and up and up and up. But what's very interesting is that historically, remember that gold does not pay a yield. So historically, gold has not enjoyed it when real yields, so that's the yield you get after inflation has been factored in, have been rising. And what I've got here, I've inverted from low to high, is the real yield. So 1, going up to 2. And what you can see here is that what's very interesting is that in general, you can see that the price of gold is correlated in an inverse way to real yield. So we can see that as real yields go higher, for example, here, the price of gold goes down. And as real yields go up, the price of gold goes up. Now that relationship held all the way until essentially, the latter half or the latter parts of 2023. And what we can see here is that at this point, gold really started to rip much, much higher. And we can see that real yields actually was going lower. Now that's okay, but then really what happens here is that real yields started to go higher. We see that gold continued to rip and sort of decoupled. So that is very strange, this decoupling of the correlation here, between gold and real yields. And so my point here is that in theory, gold is all the way up here. Real yields have actually gone higher. So if real yields have gone higher, that should make gold less attractive. So what's going to be interesting is whether this correlation, essentially this gap, closes here. And so my point is that gold was due for a pullback. And we can see here that gold, has pulled back a lot. Now, there could be some sort of support here. There's Fibonacci levels here. We've got the 2 different Fib levels. There's all kinds of, crisscross. But I think what could be kind of a pretty interesting level here is something like maybe even all the way down here. You got something like, sort of 2180. I mean, if we put it on the spot price, you're looking at maybe these levels down here, something, around about 2200, 2150 or so. This is going to be very, very, very interesting. And then if you also look, what is also kind of interesting is to look at a couple of ratios here. So we see the gold really started taking off here. And I want you guys to notice here, this is kind of like March of 2024. But if we look on some ratios, let's say if we start looking at TIPS, which is a proxy for real yields, and I think I've got it here. I've got a gold TIP here. You can see here that going back to that period is when gold started. This is gold divided by TIP, and TIP, of course, the TIPS is like inflation adjusted, so it's like the real yield proxy. You see here that gold's really, really started to outperform the TIPS. Then it started to go up. Now we're starting to see that come off. So my question is here, could the gold versus TIP ratio, could gold now underperform the real yield proxy of the TIP ETF and maybe get down to, maybe get down to something like this 190, 185 level, something down here, which of course corresponds to that level where gold really started to outperform the TIP. So that's something which is going to be pretty interesting here. And this price down here, 190, 185, corresponds to where gold was, trading at around about 2210, 2205 or something like that. So that's definitely something to be interested in. And I think if we get a hawkish, sort of a hawkish Fed on the back of a hot CPI, I think gold, if we just go back to that, the gold chart could really have, there's a bit more downside there. So that's something which could be pretty interesting. Just while we're thinking about the commodities as well, I'm going to go here and just put on, let's say, the DBC, which is like a general, we could look at the general ETF for sort of commodities with quite a heavy thing on oil and the energies here. But we see here that that's pretty weak. I mean, could that get all the way down here to 2175 or so? It's been struggling, the DBC, the commodity ETF here. And so you've got to say that could be a buy on dip there, but it looks like it's broken some key horizontal support here. So the other thing to note, guys, is that if the commodities as a general basket, we have the metals, industrial and precious falling down, and we have oil, which has been relatively weak. Could we see, how could we see the yields really ripping much higher? I'm not saying that yields cannot stay at these levels, but the idea that inflation is going to rip much higher, to me, it seems a little bit sort of stretched. So I don't know that inflation can go too much higher. So anyway, so let's have a look finally just at the equities here. And I'll just put it on, let's use the cash index, SPX. And what we can see is that, technically, can this still go higher? I think absolutely it can. But we're starting to see just a little bit of sideways action here, which doesn't mean it's bearish, because this is still an extremely bullish chart. But I think that on the SPX, it would probably have to close lower than, let's say something like, around about 52 100, around about here, to show some kind of bear signal. And maybe the first bear signal would have to go, let's say 52, 55. So I think number one would be down here, a close below 52, 55, 56. That would be a first bear signal. Then maybe we'll get some kind of consolidation. But to be honest, why would it go any lower here? We have a relatively strong economy. And as I said, with commodities not really ripping higher, you've got to say that the chances of a massive upside acceleration in inflation and therefore yields is doubtful to me. And therefore, until and unless bond yields can really rip a lot higher, I don't think we should really be preferring bonds to stocks. Now, that's not to say that stocks cannot correct. As I say, if you look this as a reference, 52.60, 52.55. But in terms of absolutely collapsing, no, and certainly not until Nvidia comes off. Now we know that the breadth of the market is relatively poor, and we know that a lot of the the big tech companies, especially Nvidia, has been holding up the markets. But at the moment, you've got to also think of it in terms of why would you prefer stocks versus bonds? It's not that stocks are not a little bit overvalued and that market breadth is narrow. It's just that why would you prefer the stocks over bonds? That's the kind of interesting thing. So I think, in terms to get a big sell-off, maybe all the way down to like, 50, 5,200 or something, you would probably need to see the bond yields ripping a lot higher. And, a way to see that, again, is just to look at some of the ratios in terms of the risk on. So if I go to some of my ratios here, something I like to look at is, let's say, like SPY divided by the TLT. And you can see that, it's still doing very, very well. Like the bonds are still underperforming the general index, the SPY. And until and unless we see, the SPY versus, like all of these indices, as you see, versus SHY, IEF, it's doing very, very well. One thing as well, though, which is interesting, is the RSP, which is the equal weight, is underperforming. So I would definitely keep a look at an eye on things like Nvidia. If we do have something like Nvidia and some of those big sort of tech stocks coming off, that could start to really be the canary in the coal mine. But until and unless we get that, you're not really going to see that. And even like SPY divided by XLY is still holding up pretty well. And the final one I'll have a look at here is the totality of the stock market. So ITOT divided by GOVT, which is the totality of the stock of the bond market, is still doing. They're still looking very, very solid. So my point here is that on a hawkish, well, let's say hot sort of CPI numbers, can the stock sell off a little bit? Yes. Can, if Powell rearranges the dot plot, if the Fed rearranges the dot plot and promises less cuts, can the stock sell off for a few days, down to some of those levels? Absolutely. But I think at the moment, these relationships between the risk assets is all looking pretty stable. And would need something like SPY TLT going down to, maybe 5.25. I mean, somewhere down here, really, for a true bear signal. Like this would really have to start breaking down. And at that point, it's not only going to be a question about the Fed, it would have to be evidence coming off from economic weakness, like the real economy stuff. So at this point, I think, any significant sell-off in stocks, in my humble opinion, would still be a buy, which is not to say they can't sell off short term, with the CPI and the Fed on Wednesday, maybe Thursday. But as long as the real economy remains strong, I think stocks are going to be preferred to the belly of the curve, at least. That's something kind of interesting. Just quickly here, just want to go back to the Nasdaq, and again, I think we're seeing here that. I'll just go onto the cash index. So the Nasdaq, the NDX here, again, we see that it's pretty strong. Probably the first key breakdown area is like 18, 450, something around here. What's this level here? About 18, 475. That again would be a first kind of bearish signal when and if it gets down to there. And then you have to go down to maybe like 18,200, 18,205 would be the next downside target. So you do have some pretty clear targets here. And until and unless they get down there, you've got to say that, the Nasdaq is looking strong. And if you look at global equity, the Nikkei is starting to look a little bit weak. Just throw that on, let's say, like the European stocks, it's finding it hard to push higher. If you look at the Nikkei, it's just ranging. So I think at this point, the US exceptionalism story is still in place, but I would say that because the breadth of the market, the RSP and the small caps, if we look at something like this is the RSP, the equal weight. And then if you look at, let's say, the Russell, definitely a little on the weaker side. So if anything, I think the spread trades here would be something like the Qs versus the Russell, the Qs versus the equal cap, and maybe even something like the Qs or the Nasdaq against the rest of the world. So I think the US tech sector is probably that's the one which is going to outperform, and certainly is going to outperform the stock. So maybe if it does get down, if you get like the Nasdaq index, having a bit of a tumble down to this level here, 18,200-ish. I think, over the next couple of months, that would be interesting to buy some kind of, upside, maybe some calls or some call spreads. Something like that could be pretty interesting. So I think I'm going to leave it there, guys. Actually, the final thing I just want to have a quick look at, I personally think it's looking a bit weak, is oil. Hold on, let me just find the oil chart. We had a little trade on there, displaying this bounce. And again, as you can see here, it's kind of stalling out there. Just because at the fib levels here, it's starting to stall out here. We got this bounce up. I exited that trade on Friday. Just because the price action here, it's still technically in a downtrend. Now, can this continue to go up? Absolutely, yes. But the price action for me, at this point, the bulls are just on this reactive oversold kind of bounce here. They've just got to the 38% level in this, and they haven't really pushed it up. So at this point, I'm out of that trade. We'll see what's happening. I think oil at this point is a little bit neutral. It's probably going to have to wait and see some more economic data and maybe see what the Fed has to say and the CPI. Anything with very, very hot CPI and a hawkish Fed, I think oil could be under a little more pressure. On the other hand, if we get neutral Fed and neutral CPI, oil market could, maybe push a little bit higher. We'll have to see. We'll talk about that a little bit next week. So that's about it, guys. As I say, let's just see how the market goes overnight with the European bonds. I'll be curious to see if the European bonds have too much of a reaction, and the euro looks like the currency is there. The other thing as well is that apart from the CPI and the Fed, is that we have the Bank of Japan on Thursday evening, I believe. We'll talk about that a bit later on, but that's going to be pretty interesting. And of course, that's obviously going to be a bit of a function of what happens with the Fed and the US dollar and the yields and all that kind of stuff. But we'll talk about that later in the week. I'll leave it there. It's getting a bit long. Have a great Sunday evening, and we'll be in touch soon. Thank you.